Ladies and gentlemen, welcome back to the channel. Today was not exactly a great day. A little bit of a reset, if you will, from yesterday. Yesterday was a really good day. Now, we have a bunch of news to cover in this video, and we're going to make this market make some sense. So, hit the like button, subscribe to the channel if you have not done so already, and check that link out down below in the description of today's episode if you guys want to come join the trading community where we are going out to find the next big winners. The stocks that nobody's really looking at that are going to grow into massive companies in the next 12, 24, 36 months. Okay, that's the idea. That's what we're doing, link down below. But with that said, let's get into your breaking news today. Okay, so one of the biggest stories today is Nvidia. Nvidia's CEO Jensen Huang has softened his China will win the AI race remark to the Financial Times. Jensen Huang initially told the Financial Times that China would win the quote-unquote AI race before clarifying that America must race ahead. Yeah, that doesn't sound great. Why? Because the country that wins AI wins like the new world order, if you will, right? America cannot be the dominant country if we do not win the AI race, okay? This is something Ray Dalio talks about a lot. I'm not as doomsday-ish as Ray Dalio, but whenever there is a competing competition, like take the Cold War for an example, Russia or the Soviet Union versus the US, one of those countries, whoever loses, loses the race to the top, right? They become a lesser country versus the other one, or just have like an internal collapse like the Soviet Union did. So Jensen Huang saying the U.S. is not going to win the AI race is not great. One of the reasons that we have, low interest rates and things like that is there is a lot of outsized demand for U.S. debt. If you're no longer the number one country anymore, that starts to become a huge issue from a financial perspective, among many other things. I mean, I can make a video for like an hour on this, but Jensen Huang, arguably the face of AI and the birthplace of AI itself, saying that the US is not going to win the AI race doesn't sound great for markets. Okay? Now, Jensen Huang kind of clarified this. He said, quote, "As I have long said, China is nanoseconds behind America in AI. It's vital that America wins by racing ahead and winning developers worldwide." This is something I talked about maybe a month ago, but I think the next actual correction in this market probably happens in 2026 when you have another DeepSeek moment, right? A moment in which Wall Street says, okay, maybe America's not going to win the AI race. Like Jensen Huang saying this doesn't sound great, but America is still clearly ahead in AI. At some point next year, maybe in the second half of the year, China's going to come out with a better GPU than Nvidia or better progress on something, and it's going to spook investors at some point. This is kind of a heads up on that. Now, I think this is actually bigger news because this is very problematic. I think Wall Street's a little nervous about this. The FAA will cut flights by 10% at 40 major airports due to the government shutdown. This is because people are not being paid for work, so they're calling off. They're, in some cases, quitting. Now, this could be very disruptive for the U.S. economy. If people are struggling to get from point A to point B, that becomes an even larger issue. Now, it's hard to quantify exactly what the consequences would be, but think about freight. Think about FedEx and UPS and all these planes that, are carrying things across the country. Think about people that may work on Wall Street or work at banks or, just need to travel for work that maybe cannot Okay, this starts to have a larger quantifiable impact on the economy. Now, yes, people are not getting paid and all of that sucks, but that alone is not a major drag on the economy. But when you start to cut flights by 10% at 40 major airports, that's going to put even more pressure on what Wall Street thinks is already a weak economy. And it's also going to put a lot more pressure on senators and lawmakers to get the government reopened. And I think that is the biggest obstacle in markets right now. Wall Street wants the government to open. They want economic data. They want clarity and they want certainty. And this is 37 days into the government shutdown, and things do not look like they're getting better. And, normally government shutdowns are not recession catalyst, but Wall Street's like, hey, we didn't start this government shutdown on solid grounds. We started this on shaky grounds. Now we're not getting economic data. Over a month has passed, and Wall Street's getting more and more nervous. Now, today in the news, job cuts in October hit the highest level for the month in 22 years. Challenger says job cuts for October totaled 153,074, a 183% surge from September and 175% higher than the same month a year ago. It was the highest level for any October since 2003 and has been the worst year for layoffs since 2009. Companies in the technology sector announced 33,281 jobs, nearly 6 times the level in September. Now, Challenger says you can attribute this to AI. They say, quote, like in 2003, a disruptive technology is changing the landscape. They say that, at a time when job creation is at its lowest point in years, the optics of announcing layoffs in the fourth quarter are particularly unfavorable. It says, quote, some industries are correcting after the hiring boom of the pandemic, but this comes as AI adoption, softening consumer and corporate spending, and rising costs drive belt tightening and hiring freezes. Those laid off now are finding it harder to quickly secure new roles, which could further loosen the labor market, Challenger said today. So again, the reason why stocks have come under pressure recently is because of fears of a recession via the government shutdown. So getting data like that today is not ideal. And you can see the VIX today is up about 3.2%, now to 18.59. So the VIX is actually going up further. The VIX EQ is up as well today to almost 40, but has remained pretty stable in the last couple of days. The VIX EQ is the VIX, but on an equal weight basis, not the headline VIX that is market cap weighted. The U.S. has announced changes in reciprocal tariff rates with China after the agreement, per Reuters. Now, Trump may have to refund tariffs, and some of the stocks that could benefit the most, Wells Fargo says, are stocks like Caterpillar, Nike, Five Below, Best Buy, and Gap. Goldman Sachs expects a Supreme Court ruling by January, with refunds potentially taking months to process. This is another big uncertainty right now, is what's going to happen with the court case on tariffs in the Supreme Court. Okay, are we going to see tariff refunds? Are we going to see tariffs be canceled outright? Probably not. But what other measures is Trump going to be able to take to keep tariffs enforced? Are they going to be a lesser amount? Like, there's a certain act, I think it's Act 212, or there's one that's like 332 that says you can have 15% tariff rates in place for 150 days, for an example. Like, that would be dramatically lower on something like China that's at a 47% tariff rate, or many other countries. But is that going to happen? Is it not going to happen? It's very uncertain. And when you have an uncertain environment like this, you get business investment that slows down, because companies are like, hey, do I want to invest in a factory here? Do I want to invest in a factory over here? If things can change so rapidly, that makes you second guess how fast to invest. Now, in good news today, the U.S. has no current plans or legal basis to strike Venezuela, officials tell Congress. Now, per Bank of America today, they say shoppers are bearing 50 to 70% of total tariff cost, with businesses bearing the rest. So again, if tariffs are canceled, in theory, that would be really good for markets. That would be good for inflation, getting inflation lower. That would be good for the economy, okay? And good for getting more Fed rate cuts. But on the other hand, it does introduce more uncertainty that could be seen as negative for the markets and the economy. And Nancy Pelosi announces her retirement from U.S. Congress. Fed Goolsbee says today, I lean more to, quote, when it's foggy, let's be careful and slow down. Fed Goolsbee says the settling point for rates will be a fair bit below where it is today. Goolsbee says, I am not hawkish on rates in the medium term. Goolsbee says for data to go dark right at the moment we saw services inflation rising is uncomfortable. Goolsbee says more uneasy about rate cuts without inflation data. U.S. Trade Representative Greer says Trump never purported to have unlimited tariff authority, which we know he does. Trump puts tariffs on whoever he wants, whenever he wants, for whatever reason he wants. Like that's misleading. The White House has said the United States has the strongest economy, the strongest borders, the strongest military, the strongest friendships, and the strongest spirit of any nation. JP Morgan says that retail investors to keep lifting stocks. Retail inflows should continue to support equities into year-end, JP Morgan says, citing strong seasonal trends. The S&P 500 has risen for 6 straight months and hit 36 record highs, driven by AI-linked tech stocks. JP Morgan expects retail momentum to last into early 2026, with equity ETFs drawing about $160 billion in inflows recently. The rally has paused amid profit-taking and uncertainty over U.S. policy and Fed rates. Still, Goldman Sachs' Richard says any pullback should be brief, calling equities a buy on the dip. And finally, something that makes sense from Congress, Senator John Kennedy is to introduce 2 bills to stop Congress from getting a paycheck during the shutdown. So here you can see the Fed rate monitor tool is still pricing in a 63.3% chance of a rate cut coming on December 10th, and almost a 37% chance of no rate cut. For January 26th, you are pricing in a pause after a December cut at about 53% odds. You are pricing in no cut at all in December or in January with about 22% odds, and 50 basis rate cuts worth of cuts by January 26th at 25.1% odds. So the odds are all over the place, and that just makes markets a little on edge right now. Now, the AI Investor Sentiment Survey did release a new update today, showing 38% of investors are bullish, with neutral investors that rose a lot in the past week, from 19.1% to 25.8%. Again, bullish investors dropped from 44% to 38%. And bearish investors remained roughly the same at 36.3%. So this is a very divided market, which, you know, typically if you have a similar amount of bears and bulls, that's a bearish market. Like, stocks go up on aggregate. People tend to be a lot more bullish than bearish. But they're not right now. Now, if you look at the CNN Fear and Greed Index, you're coming in at 30, which is on the low side of fear. That's better than where we were 2 days ago or yesterday when you came in at 24. You were in extreme fear following the recent pretty major sell-off you've seen in risk assets like small caps, like crypto. Look at Bitcoin. It was recently as high as $126,000. Today, around $100,000. You've seen a pretty dramatic sell-off in risk assets. Now, market momentum is fear, stock price strength, extreme fear, stock price breadth, extreme fear, put and call options, extreme fear, market volatility is neutral, safe haven demand is greed, and junk bond demand currently in extreme fear. And if we look at the percent of stocks trading above their 50-day moving average today, coming in, at 38.8%. So actually not a bad day at all, but you're getting down to pretty concerning levels, okay? You've seen quite a drop in the percent of stocks trading above their 50-day moving average, and you're kind of getting into correction territory at this point. Now, 10-year Treasury yields, it says here, retreat after a big jump in October layoffs. 10-year Treasury yields are down about 6.5 basis points, down to 4.093%. So the economy is really on edge right now. With the economic data we're getting. Like yesterday, we had ADP employment that showed private payrolls rose over 40,000, double the estimates on Wall Street. That's great. And then today we get Challenger job cuts that show, oh crap, this is the worst October in 22 years for planned layoffs. And now Wall Street's like, okay, well, economy's back to the shithole. Okay, I don't think you're in the shithole, but there's a lot of uncertainty, okay? Wall Street just really doesn't know what to think because we're not getting that much economic data. We're not getting retail spending. We're not getting retail sales. We're not getting GDP. We're not getting initial jobless claims. We're not getting the payroll data. We're not getting CPI. So this data that we're getting is kind of back and forth, okay? So that's the biggest problem right now in markets is people are fearful that the economy is weakening too much. And, rate cuts are great. They might slow that down a little bit, but the government shutdown is adding more and more pressure by the day on this economy. There are some reports that Q3 GDP could be reduced by 2% because of the government shutdown. Okay. And it's really hard to quantify exactly how much damage is going to be done by reducing flight traffic by 10%, right? It can't be great, but it's really hard to figure out how much damage that is actually causing. Now, good news is, I think markets falling, air traffic starting to be reduced is going to put a lot of pressure on the government to reopen. And when the government does reopen, I think that is a positive catalyst for markets. And you are in a very seasonal, bullish period for markets as well. So yeah, I think it's pretty safe to say the markets are freaking out a little bit. Like every day there's something new that we're reacting to that, some days we're getting good news, some days we're getting bad news, but Wall Street just really doesn't know what to think at this moment. Let me know your thoughts on this down below in the comment section. How you are positioning in this market, if you're buying the dip, if you're in cash, what you are doing, okay? Because honestly, there's really no right or wrong answer with this much uncertainty. Now, we do have some earnings today and after hours. I will mention just before we wrap up this video, the Trade Desk, Open Door, MP Materials, Iris Energy, SoundHound, DraftKings, NewScale, Archer, Enodata, and Airbnb. And then tomorrow, Wendy's, Six Flags, Duke Energy, and some others as well. So hit that like button. Subscribe to the channel if you have not done so already, and check that link out down below in the description of today's episode if you guys would like to come join the trading community and come identify, invest, and, execute and hopefully get rich in some of these stocks that I think Wall Street is really ignoring. Okay, I don't think AI is going away anytime soon. In fact, the competition with China, Jensen Huang's comments just really reiterate the bull thesis for AI, that it's time to get to work. It's time to compete. And I think that's exactly what's going to happen over the next 5 to 10 plus years. So again, let me know your thoughts on that down below in the comment section. Link down below in the description of today's episode if you guys want to come join the trading community. Have a great rest of your day, and I will see you in the next one.